Hello. In this first topic for Accounting 3221, Intermediate Accounting 1, we shall take a look at financial reporting landscape in Canada. My name is Dr. Harjinder Deol, and I'm the instructor for this course. The learning objectives for this particular topic include developing an understanding of who prepares financial reports and why, distinguish between types of reporting entities in Canada, identify applicable financial reporting frameworks, navigate the CPA Canada handbook, develop an understanding of the structure and purpose of annual reports, and also finally recognizing emerging developments in sustainability reporting. So let's start first with taking a look at what financial reporting is. Financial reporting is the process of preparing financial statements along with accompanying notes that describe financial position, financial performance, and cash flow. Now, it is important to keep in mind that financial reporting is about external communication and not internal decision making. So that is a key distinction for financial reporting as opposed to managerial accounting. Now, this distinction matters because external users, such as investors, creditors, regulators, they do not get to ask follow-up questions from the company. So standards, financial reporting standards, they exist because of this asymmetry in the information that is available. External users do not have access to current information about the company that internal users, such as management, would have. Okay. Another thing to keep in mind is that whereas managerial accounting is quite flexible, it's forward-looking, but it's meant for internal users, financial reporting, on the other hand, tends to be more standardized, historical-oriented, and primarily supposed to provide information for decision-making by external users. Who prepares financial reports? So we have publicly accountable entities. For them, financial reporting is mandatory, and it is accompanied with extensive disclosure requirements. We have private entities. For them, the reporting is often driven by existing debt covenants, as well as to comply with regulations. Since the owners tend to often be hands-on for private companies, they would typically not need the standardized reports that financial reporting facilitates. We have not-for-profit organizations. For them, reporting is needed because they receive government funding. It also establishes accountability to donors and members. Right? So in sum, public companies prepare financial reports because capital markets demand them. Private companies, they prepare financial reports because lenders and regulators demand them. And lastly, for not-for-profit organizations, financial reports help assert accountability for public or donor funds. So it's important to keep in mind that financial reporting is not optional if shares aren't traded. You can have private companies also prepare financial reports because it is required by lenders. In Canada, there's two broad categories of entities, the private sector and the public sector. Right? It is important that we understand what kind of entity we are working with. In the Canadian landscape, financial reporting is not a one-size-fits-all endeavor. In Canada, we have deliberately adopted multiple frameworks, and that's different from other jurisdictions where IFRSs might be pushed for all types of organizations. In intermediate accounting, we will be focusing more on publicly accountable enterprises and private enterprises. Let's take a look at private sector reporting entities. These include publicly accountable enterprises, or PAEs. These are companies that have publicly traded equity, so shares, or debt, bonds. Financial reporting for publicly accountable enterprises is mandatory, right? So it's important to keep in mind that we are not conflating publicly accountable with the public sector, okay? Public sector is about government organizations. Here, we're talking about companies that have issued shares or bonds that are traded on public capital markets. All right. Publicly accountable enterprises also include entities that carry out business in a fiduciary capacity. So this would include banks and insurance companies, right? So in that case, even if the organization does not have publicly traded shares, they will be required to use IFRS for financial reporting. Private enterprises, these are profit-oriented businesses, but they're not publicly accountable, i.e. they don't have any publicly traded shares or bonds. Okay, so it's important to keep in mind that the share ownership, right? The shares might not be publicly traded, but if let's say they have bonds that are publicly traded, the company will fall under the rubric of a publicly accountable enterprise. Okay, so in order for us to assert that a company is private, it must not have any type of publicly traded financial instrument. Not-for-profit organizations, these are entities that are, the name as the name suggests, they're not run for earning or generating a profit. They do not have any transferable ownership interests like shares. Instead, they are organized and run for some nonprofit purpose, such as achieving some social goals, some charitable purpose, or community needs. Finally, there's pension plans. Now, pension plans are very, very, very specialized entities. They are governed by a specialized reporting set of reporting standards that are covered in what we call Part 4 of the CPA Canada Accounting Handbook. The public sector reporting entities include government components. So these would be ministries, departments of the government organizations, government business enterprises, and finally, government not-for-profit organizations. So for example, Mount Royal University is a government not-for-profit organization. So the public sector, we have to keep in mind, the public sector is quite different from the private sector. The objectives are different. The government seeks to provide services versus generating profits. Their funding sources, of course, the government raises revenues primarily through taxation, whereas for the private sector, for businesses, the money is typically raised through investors. Now, here's an important overlap. We have government business enterprises. So government business enterprises, they are actually businesses that happen to be owned by the government. So The fact that they are government owned does not automatically mean that public sector standards would apply there. Government business enterprises, they often look and act like private companies. Think about Canada Post. Canada Post is a crown corporation. It is a government business enterprise, and it, well, basically has to follow the same reporting requirements as other um, um, publicly accountable enterprises. And so that would mean they have to follow the same set of standards as publicly accountable enterprises. Let's take a look at who sets accounting standards in Canada. For the private sector, we have the Accounting Standards Board. For the public sector, there's the Public Sector Accounting Board, the PSAB. Now, in Canada, the Accounting Standards Board decided that for publicly accountable enterprises, we would use international financial reporting standards. Now, the body that sets the International Financial Reporting Standards, or IFRS, is the International Accounting Standards Board, the IASB. Okay, let's take a look at the financial reporting frameworks that exist for the private sector. So firstly, publicly accountable enterprises, they must follow Part 1, IFRS. Okay, IFRS is mandatory for publicly accountable enterprises. They don't have any choice. For private enterprises, they may follow IFRS. It's an option that is available, but the mere fact that it's optional does not often mean that it's advisable. Okay, so quite often, you'll find that private enterprises, they prefer to adopt and follow Part 2, which is accounting standards for private enterprises. Okay, so the mere fact that it's an important thing to keep in mind that ASPE is by no means a lesser standard. Okay, so it's not let's say a diluted set of standard. ASPE has been deliberately created to meet the reporting requirements, the needs for private enterprises that don't have publicly traded financial instruments. Right, so it's geared more towards meeting the informational needs of creditors and regulators, for example. For not-for-profit organizations, just like for private enterprises, IFRS is an option, but Part 3, which is accounting standards for not-for-profit organizations, possibly meets their reporting needs better. So Part 3 tends to be the set of standards that are used or followed by not-for-profit organizations. Now, Part 3 is not a fully self-contained set of standards. So there may be areas where Part 3 ASNPO does not specifically address an accounting issue. In that case, not-for-profit organizations have to consult Part 2, ASPE. Okay, so it's accounting standards for not-for-profit organizations, Part 3, supported where needed by ASPE. Lastly, for pension plans, they have their own set of standards, and that's accounting standards for pension plans, ASPP. IFRS, as I've said, is optional for private enterprises and not-for-profit organizations. Why do we have IFRS being mandated for public companies? Firstly, it helps with global comparability, right? Companies are often, they have investors from foreign countries. They may be cross-listed in Canada as well as, say, in the US and other jurisdictions. So this helps, with the comparability of the numbers. Analysts are able to compare companies across countries. It helps facilitate cross-border capital flows. Keep in mind it's required in over 120 countries. Overall, following IFRS enhances transparency for investors. So it's about decision usefulness. And sometimes there is an allegation that IFRSs are complex. They are not meant necessarily to be complex for its own sake, right? IFRS is also described as principles-based, requires judgment, and this is a theme that you're going to encounter later on in the course. And there's a bit of a sacrifice in terms of precision. IFRS does not give you as many rules as sometimes people would like, to have. Often we would want to yell, "Oh, just tell me what to do." And IFRS does not. Often IFRS will stop short. IFRS gives you, well, consider X, Y, Z, consider the transaction, the nature of the entity, and what the informational needs might be of users. So IFRS will often provide options that are more numerous than you will encounter under ASPE. So it is very important for us to know what kind of company we are dealing with, because that will tend to be the first step for us to go refer to the handbook to find out how to account or how to report on a certain matter. So by way of an example, let's take a look at Global Tech Solutions. We're told that this is a publicly traded company. It's publicly traded on the TSX Venture Exchange. So because the company has shares that are publicly traded, it is a publicly accountable entity. So in that case, there is no option other than following IFRS. In contrast, consider Prairie Farms Company. It's privately owned. It does not have any publicly traded debt or equity. So here, you have a choice between ASPE and IFRS. Okay, now ASPE was deliberately carved out from old Canadian GAAP. Canada, we adopted IFRSs starting January 1st, 2011. So before that, we used to have what was referred to as Canadian GAAP, generally accepted accounting principles. We created ASPE because IFRS can be a bit costly because of just the extensive disclosure requirements. It can be costly and, quite frankly, not necessary for private companies. ASPE supports simpler measurements. It requires fewer disclosures. But it's important to keep in mind that just because ASPE is simpler doesn't mean that it's less rigorous. Okay. Another thing is sometimes private companies can still make a decision to choose IFRS strategically, maybe because they're planning an initial public offering, right, in the future, and in order to facilitate that, they may voluntarily follow IFRS. Consider Community Wellness Foundation. We're told that it's a registered charity and receives government grants and donations from individuals. Now, just because it doesn't have a profit motive doesn't mean that community wellness lacks accountability, right? So performance for a not-for-profit organizations is still measured just differently. So we, for example, instead of preparing an income statement for a not-for-profit organization, you prepare something called a statement of operations. We still provide information about revenues, we provide information about expenses. The difference between revenues and expenses, though, is not called net income, but we use a different label, excess of revenues over expenses. So for not-for-profit organizations, accounting standards for not-for-profit organizations, ASNPO, which is part 3 of the Canadian um, um, accounting handbook, is more suitable. IFRS are allowed, but it's often not a good fit for a not-for-profit organization. Consider evergreen pension plan. Now, pension plans, they are esoteric, specialized entities. They essentially manage the pensions, obligations, and plan assets on behalf of other companies. Now, because of the very specialized nature of their operations, there is Part 4, Accounting Standards for Pension Plans, ASPP, that are applicable to them. What about the city of Calgary? Well, the city of Calgary is at a municipal level. It's a government. It's a government entity, and therefore it has to follow public sector accounting standards. What about Canada Post? Now, Canada Post, even though it's owned by the government, it is a government business enterprise. All right. So although it looks public, Canada Post, well, at least in principle, is supposed to act commercially. And so therefore, IFRS is the applicable standard for Canada Post. Now, I've been mentioning the CPA Canada Handbook. What does it contain? It contains all Canadian financial reporting standards, as well as auditing and assurance standards. And the recent addition to that is sustainability standards. Where can you locate it? Well, it comes, you can locate it under a specialized database called NOSHA, which is in collaboration with CPA Canada. At Mount Royal University, we subscribe to the NOSHA database, and you will find a link to the NOSHA database on your D2L website. And from time to time in class, I will be pulling up the NOSHA database to demonstrate how we can use it. How would you navigate the handbook? Well, the first step is to determine what kind of reporting entity are we dealing with. And because that will give us a hint, a clue into, okay, should we look up IFRS, or should we look up ASPE, should we look up ASNPO, or the Public Sector Accounting Handbook? You don't need to worry about the public sector standards at this moment, but in a later course, in advanced accounting, you will encounter them. Once you have determined the reporting entity, then we can narrow in on what the specific accounting issue is. So for example, if we are dealing with an issue with revenue under IFRS, the applicable standard would be IFRS 15. And then finally, you have to keep in mind that in IFRS, the standards are numbered, so when we provide citations, we have to cite both the standard and the specific paragraph. Under ASPE, the citation formatting can mimic IFRS, and that's what we will be using in our course, but the reference is typically to the specific section of ASPE. And the authoritative text for ASPE is shown in italics. For IFRS, it's shown in bold text. And we will learn more when we do actually access the handbook in class later on. Next, let's consider the regulation of publicly accountable entities. In Canada, we have the Canadian Securities Administrator. We in Canada, don't have a single national securities regulator. So the CSA, it basically coordinates individual provincial regulators. Because we have the Toronto Stock Exchange located in Ontario, the Ontario Securities Commission, the OSC, plays a dominant role, right? The Office of the Superintendent of Financial Institutions, OSFI, it regulates financial institutions, not all public companies. So here we're talking about banks, okay? So keep in mind that we should not conflate reporting standards with regulation, okay? So regulation is, it includes reporting as well. Reporting is a requirement for publicly accountable entities, but they have to jump through a lot more hoops. Let's just keep it at that. There's way more requirements for publicly traded companies, publicly accountable enterprises, and depending on their nature, those requirements are set by the Canadian Securities Administrators, or specifically the Ontario Securities Commission, or OSFI. In the US, the Securities and Exchange Commission is the body that sets regulations for listed companies. Next, let's take a look at corporate governance and audit. Oversight in Canada, the body that sets the requirements is CPAB, Canadian Publicly Accountability Board. In the US, it's the PCAOB, the Public Company Accounting Oversight Board. Now, both of these entities or these organizations, they exist because investors rely on financial statements that are audited. And if there are audit failures, they would undermine confidence that investors have in capital markets. So one of the primary purpose of the existence of the CPAB or the PCAOB is to ensure audit quality. Okay. We also need to ensure that auditors are independent, because if there's conflict of interest, the overall quality of the audit might not be high. And of course, all of this is there to protect investors. Now, it's important to keep in mind that financial reporting quality depends as much on enforcement, and auditing is an important part in the in ensuring the credibility of the financial reporting. So it's not enough to have high quality reporting standards if those standards are not followed. Okay, so audit is an important mechanism by which it is ensured that the reporting standards are actually being followed. Next, let's talk about annual reports. So annual reports communicate to users information about past performance, the current financial position, at least as of the fiscal year end. They provide information about the future outlook as well as strategic direction. Right? So here we have to keep in mind that annual reports are communication tools. They're not just compliance documents. They serve the needs of both sophisticated users, which would include financial analysts and institutional investors such as mutual funds, pension funds, etc. They also meet the needs of less sophisticated users. That includes retail investors, or in the case of not-for-profit organizations, donors. So financial statements only are not sufficient for them. We have to provide more of a narrative context. Now, that's included in the annual reports. Annual reports are typically available from companies' websites, as well as there are dedicated websites. In Canada, we have the CEDAR, and in the US, there is EDGAR, EDGAR, which are repositories of companies' annual reports. What are the components of an annual report? It includes financial highlights, followed by management discussion and analysis, followed by financial statements, notes to financial statements. And it's important to keep in mind that the auditor's report precedes the financial statements within an annual report. Notes are integral to financial statements. If we ignore the notes, we will end up with incomplete analysis. Let's take a look at a little bit more detail about management discussion and analysis. The purpose of MD&A is to kind of show the company's performance through the eyes, through the lens of management. We're not trying to just, beat our own drum. We're not only trying to talk about the positives. It should provide more of a balanced perspective of how management sees, top management sees the company's performance, past performance. So they're meant to supplement financial statements. They're principles based. They don't have rigid rules, and it does allow for management judgment and framing of the narrative. Right now, this is where sometimes the tension arises, because the MD&A does talk about strategy, the company's resources and risks, its past results and outlook for the future. And sometimes what ends up happening is that people or the preparers might go a bit overboard on strategic optimism rather than focusing on just providing an explanation. The MD&A, a well-prepared MD&A section, should reveal to users risks that are not obvious from just looking at the numbers. But we have to be very careful about the potential for management bias, because management, more likely than not, is going to use a more optimistic tone. So we should not discount MD&A, because it does give us at least a sense of how management of the company, top management, perceives where the business has been and where it is headed. Looking at financial statements, there's 4 core statements: the statement of comprehensive income, statement of changes in equity, statement of financial position, and statement of cash flows. These are, of course, IFRS terms. The counterparts would be in ASPE: income statement, statement of retained earnings, balance sheet, and cash flow statement. For a not-for-profit organization, the income statement or the statement of comprehensive income is instead referred to as a statement of operation, right? The names, of course, reflect purpose. Not-for-profit organizations, they don't earn profit, so they tend to shy away from using profit-oriented terminology. In ASPE, there is no concept of other comprehensive income, something that we will be learning about in this course later on. So therefore, we use a simpler statement name called income statement. The key standards that apply under IFRS, you have IAS 1 currently, but it is soon to be replaced by IFRS 18. And ASPE, it's section 1400. Notes are an integral part of financial reporting. They provide details about accounting policies, breakdowns of specific line items, and information about items that are not explicitly recognized in on the face of the financial statements. Now, under IFRS, notes are quite extensive because under IFRS, there tends to be a bit more measurement uncertainty. There is inclusion of fair value estimates. There is greater use of judgments and assumptions. So the notes then make it clear, they explain how the numbers that are reported in the financial statements were generated. And they also, through the process, reveal risks and sensitivities of which users should be aware. The auditor's report is mandatory for publicly accountable entities. It's prepared under or in accordance with Canadian auditing standards. It's meant to express an opinion whether the financial statements are fairly presented and are in compliance with the reporting framework. Recent enhancements, recent changes over the last 7-8 years have increased the value of the auditor's report. Now, having said that, it is important to keep in mind that an audit opinion is not a guarantee because audits are conducted on a test basis. All they can do is provide a reasonable assurance. Now, recent enhancements, including discussions of key audit matters, requirement of use of more entity-specific language, have definitely been an improvement, been an enhancement on the usefulness of an auditor's report. But we have to always keep in mind that an auditor's opinion primarily focuses on fair presentation, and it's not a guarantee of a business's success in the future. A recent trend has been enhanced or increased sustainability reporting. It's primarily driven by investor demand. We're not talking about companies just trying to do the good thing or the right thing. It's gone beyond ethics. Investors are actively requiring companies to provide sustainability reports. They tend to be forward-looking and discuss risks that a company is faced with. Sustainability risks, they increasingly have an impact on cash flows, asset values, the company's cost of capital. So it is inextricably linked with long-term value creation, right? It's not voluntary stuff. The focus tends to be on ESG, environment, social, and governance. So recently, the International Financial Reporting Standards Sustainability Board was set up, and they have come up with 2 sustainability standards. The board was set up by the IFRS Foundation in 2021, and they have issued standards, IFRS S1 and IFRS S2. The first standard deals with general sustainability disclosures, and standard 2 deals with climate-related disclosures. These standards have been effective for annual periods beginning on or after January 1st, 2024. So 2025 onwards, we should see more embedded sustainability reporting by companies. The core principles of IFRS S1 and S2, they focus on materiality. So it's the same concept as for financial reports, but here you take into consideration more broader risks than just dollar amounts. They focus on connectivity with financial statements, so they link sustainability to financial statements, and the emphasis is on fair presentation. So provide more of a balanced disclosure and not greenwashing. There are four pillars that kind of provide a structured way to analyze any sustainability issues. They include governance, so who provides oversight within a company, strategy, why does it matter, risk management, how are risks handled, and then metrics and targets, how progress is measured. Looking at governance, so governance, here we're answering the question, who is in charge and how seriously is this matter taken? Right? So it's investors are not simply asking, oh, are we green? Do we care about the environment, etc. It goes beyond that, right? So here you're trying to assess whether the board that provides corporate governance is competent and accountable. So we look for whether there's active board oversight, and do they actually oversee management execution of sustainability related actions? We also assess whether discussion of sustainability risks actually do elevate to the level of the board. An example of weak governance would be where, say, sustainability is simply treated as a reporting exercise rather than a risk management issue, right? So it is important for us to keep in mind that sustainability is integrated within existing governance structures, and sustainability considerations are actively made when companies make important decisions about resource allocations, etc., etc. Strategy. Now, this answers the question, why would sustainability matter financially, right? So here's where sustainability stops being an abstract concept and becomes more of an economic issue, right? So in this course in Accounting 3221, you learn about impairment testing. So sustainability issues can have overlaps with the risk of impairment, the changes that a company might face regarding its cost structures, shifts in demand from an economic point of view, right? So under IFRS S2, for example, scenario analysis, it's not just about predicting what might happen, it's actually performance of a stress test on the company's existing business model, right? So in the strategy part, we consider effects of sustainability on revenues, costs, assets, liabilities, and we perform stress tests relating to transition, climate transition, and the company's resilience or lack thereof when faced with such climate risks. We take an overall holistic look at the business model and whether the company's supply chain, the value chain, is robust to the risks that it faces. Which leads us to risk management. So risk management here, we're talking about the process. So we can never get certainty, but we can definitely take steps or actions that can help us mitigate or manage the risk that we are faced with. So here in the risk management, it's identification, assessment, and management of processes that help us identify sustainability risks. We assign probabilities, likelihood, and the size of potential losses that the company might be faced with, for example. And how do we now integrate these sustainability risks within the overall company's risk management setup? And of course, we want to keep monitoring and take actions to mitigate over time. So it's important that IFRS does not expect precise measurement, because that may not be possible, but it does expect clear identification, logical prioritization of the risks, and ongoing monitoring, right? So the fact that when you integrate sustainability risks into the overall enterprise risk management, we're assigning a degree of credibility. It's not just, oh, let's check off a box. We're saying, oh, yes, we understand that these risks are real, and we are taking steps to not only track them, but protect ourselves from them. If the company only has standalone ESG processes, then they would tend to be superficial. They need to be integrated within the overall risk management protocols. Lastly, let's talk about metrics and targets. Metrics and targets are what provides evidence that the company has actually been keeping track of its progress on sustainability reported matters. It's an indication of discipline. It is important that metrics used must align well with the overall strategy, and that they should reflect material risks and opportunities facing the organization. Targets without governance are simply marketing, so metrics without strategy are simply noise, right? So under IFRS S2, the second standard, targets related to Scope 1 and Scope 2 are mandatory. Scope 3 will follow. There is some transition relief provided. Now, these are essentially related to climate metrics, including greenhouse gas emissions. They are supposed to provide details on targets and timelines over which those targets are meant to be achieved. And it is an important principle that these metrics are consistent so as to allow for comparability over time. So this concludes our discussion of the first topic for intermediate accounting, the financial reporting landscape for Canada.